Let's have Mr. Om Manchanda of Lal PathLabs join us now to answer those questions. Mr. Manchanda, great to have you with us here. Thank you very much. Are analysts making too much of what's actually going on? Or do you think structurally there is a problem now in terms of prices that you'll be able to charge, volume growth also getting very dispersed because there'll be so many new competitors? Tell us, sir.
Good morning. So I think what's probably happening in FY23 is that entire industry is fighting the decline of COVID compared to last year. So I think a lot of sales comparison is happening because starting this financial year, COVID sales are badly down nearly about 80-90%. I think the first task for the industry is really to offset those losses with non-COVID. But probably I'll shift the focus on medium to long term. India is highly sort of under-penetrated as far as diagnostics is concerned. The first wave that we had seen was shift of unorganized to organized space in diagnostic was mainly in metros and maybe tier 1 town. I think I'm seeing a structural shift coming in due to higher competition in tier 2, tier 3. So probably my sense is we will see much more organized competition that we have seen in the past. So I think that's the way future looks like. And I think the comment about the rising competitive intensity and price war happening, at some level, I do believe that this will definitely aid the growth of the market, especially in the area of wellness or screening. And in my view, there is this competition really is not disrupting the cost structure. It's mainly disrupting the prices. So that means some of these price points may not really be sustainable. But I think one should look at a medium to long-term growth in this industry. This short-term quarterly variations are mainly happening due to COVID decline, per se.
Oh, no, that point is taken. Om, hi, good morning. The point Antique is making, especially in the Western market, if you look at suburban's contribution, non-COVID perhaps is not growing as much as you would have liked. If you could, I can understand 1 or 2 quarter, here or there. But in general, are you still confident on, the suburban bet that you have taken and whether it will contribute in a meaningful way?
Yeah, going by our experience in Delhi markets with Dr. Lal PathLabs, I'm fairly confident. And I think probably these things one should look at in much longer term. It's just been a couple of quarters the Suburban has been with us. We have to put together a few systems and processes. And I think it's going to take 2 to 3 years before we start seeing the results. And just remember that frequency of purchase in healthcare is not that frequent. It's just that sometimes patients actually come to you after 6 months or 1 year. So I think it's going to take time before we start seeing results. But I'm pretty confident that Suburban is a great platform for us in West Market and highly concentrated in one city. And we are probably building up a foundation for our future growth, especially with the launch of high-end reference lab. And any lab that we put up in Mumbai also would serve southern markets as well. So it's a pretty long-term play for us. We are not looking at Suburban from a short-term perspective.
Okay, so you're not looking at Suburban from a short-term perspective, but the problem I think is, Suburban in any case is tracking with lower margins now. I mean, the margins had fallen to 15% versus 20% plus last year. And then you have rising competition. So are we looking at a case of more margin pressure at least over the next 1 to 2 years, given the situation? And if yes, on an average, what could it be for Suburban?
Yeah, Suburban, I think we knew very well that it's going to dilute our margins because Suburban pre-COVID margins are much lower than our overall portfolio margin for the parent company. It's just that we were expecting decline in COVID, but we didn't expect that it's going to be very, very sharp decline in a very short period of time. And that has happened for the entire industry, not only for just Suburban. And Suburban, actually, contribution of COVID was very high, so the impact is also equally high. But our focus essentially would remain on non-COVID business. I think one learning that we have had from COVID in Suburban is that if the top line grows faster, you are able to see operating leverage flowing in. And I think that's clearly visible. And that's what we had seen in Dr. Lal PathLabs as well. So, I think Suburban is definitely diluting margins as far as Western market is concerned and overall parent company is concerned.
So
coming to your point about competition, I have always said before also that at this point in time, we don't want to really change the price points. And we believe that this market is not highly price elastic. And people are discerning enough as far as the quality is concerned, as far as service is concerned. And I think most important point to note is that we have to look at our cost line. Is there something wrong with that? And I'm not seeing that sort of a cost disruption which competition is having. They're just dropping the price and maybe adopting a cash burn model, which to some extent, in my view, will not be sustainable.
That's an interesting way you put it. It's not changing the cost structure. It's impacting the pricing, though. So then it's not sustainable. The pricing will maybe drift up.
Yeah, some of these companies are unlisted companies, so the numbers are not visible to me. So I presume it will be difficult for them to sustain.
Yeah. So the Antique also says that margins that you saw during FY21, right, will not be repeatable anytime soon. Revenue growth also from being 15% plus over the last couple of years should come down to about between 10 and 12%. Are those the numbers one should work with? This is a slightly longer run question.
Yeah. I think FY21 and 22, both these years had advantage of higher operating leverage flowing due to higher COVID.
Yes.
So I think that point is correct, that margins in these 2 years have been higher, not only for us, but for the entire industry. So industry won't be able to repeat these margins in the coming years. So I think there are 2-3 things we need to achieve. One is to go back to pre-COVID levels for non-COVID business. Not only in absolute terms, but from growth perspective. And it will be unfair this year for comparison on year-on-year basis, because last year base month-on-month variation is very high. There are some months where non-COVID numbers are very soft, some months where non-COVID numbers are very high. So in my view, everyone should look at a quarterly trajectory, how the trends are moving in terms of whether we are building up quarter on quarter. I think from April onwards, we are seeing very stable quarters. The next two quarters are very, very important for us to see the trend. As far as margins are concerned, I think most important is to go back to pre-COVID levels rather than what we have seen in FY21-22. I think last 2 years, margins were unusually high due to
Got
COVID.
it. All right, Om, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always.